Hey everyone, John Henry here from School of Trade, and today we're going to be talking about market personality. So, market personality is a pretty big factor in terms of day trading, and it's really an important thing that day traders are able to understand the different aspects of a market's personality to be able to get in and get out in the most efficient type of way. So there's three main categories when it comes to market personalities. The first part is going to be liquidity. The second part is going to be volatility, and the third is going to be trendiness. Now, liquidity, by definition, is the degree to which the market can be bought or sold without affecting the current price. Now, that means that on crude oil, I can place a buy order or a sell order for, 3, 4, 5 contracts. I'm not going to do anything in the market with that size. But if I come back to crude oil and I place 1,000 lot purchase order or a sell order, I'm going to move that market all over the place. Now, in converse to that, if I go to a market like, say, the S&P 500, and I drop an order to buy 1,000 on the S&P 500, I'm not going to move it that much. There's so much liquidity, there's so many buyers and sellers in that market that having 1,000 contracts come in is almost normal. You've got lots coming in for 500, 600, 300 all day long. So you're not going to move the market like you would in crude oil. So liquidity is a big factor in the markets and which markets you decide to choose to trade. So the next part is going to be volatility. Now, volatility is another really important part of the market. Now, volatility, again by definition, is going to refer to the range of movement on that specific market. So that means that a market like the S&P 500 isn't going to see fluctuations of, say, 70 points on average. But a 70-tick move in crude oil is only half of an average day's range. The volatility on crude oil is much, much higher than a market like the S&P 500. So the volatility makes a big difference in terms of the style of trading that you are going to be doing. A scalper is going to really like a large amount of volatility. Really, everyone's going to like a lot of volatility because it gives you more opportunity to make money. But volatility is going to work better in different situations, whereas low volatility, like the S&P 500, might also be good for a scalper if you're only going for 1 or 2 ticks. So the volatility in each market is a really good thing to consider when looking at trading any specific market. Now, the next part is going to be trendiness. Now, trendiness is a market's tendency to move in one direction for any extended period of time. So that means that if you take the past year as an example, all of the indices have been on pretty much a parabolic vertical tear. They really haven't stopped going up. That's the part of the trendiness that you want to consider. If a market is typically trending more than it is, say, sideways, that's the type of market that you're going to be looking at a situation where you're going to want to buy and hold instead of buy and get out really quick. Markets, and that fluctuates from day to day. So on average, a market statistically only trends 30% of the time. But during that trending period, how long and how extended does that trend go? Those are the kind of factors that you want to pay attention to. So as an example like we have here, for the S&P 500, for example, when it's trending, it's a market that has high liquidity. So the consistency of the movement, while the traders who mostly trade the S&P 500 are long-term trend followers, the market's going to tend to move in one direction for a longer period of time than other markets. The euro would be another liquid market that would tend to move more often than other markets. But on the opposite side of the coin, crude oil is a really popular market that is not a trending market at all. It goes high to low, high to low, high to low all day long. And it doesn't really have any periods of long, consistent periods of trending. Unless you zoom out to, say, weekly or monthly charts, then you might start to see those moves. So those are the three big things that you really want to consider before you start choosing which market you want to trade, because that's going to help you pinpoint the type of trading that you need to do on that market, what's the most optimal use of an ATM strategy or an entry trigger, or, all of these things can be derived from those three primary points. So that's going to be the market personalities. If you have any questions about it, feel free to send an email to School of Trade. We'll be sure to get back to you as soon as we can. Have a good one.